Hello and welcome everyone. This is Professor Siddharth Surana, Chartered Accountant. I hope you guys are doing good. और मैं तो हमेशा मस्त ही रहता हूँ. Welcome to episode number 5, Revision cum Amendments, CA Final Direct Tax, May 21, November 21. This is the 100% English version. Hindi-English mix will be separately available. I hope you remember the request which I made in the last episode, and thus now the episode which I will be putting will be available as a premiere. So every night whenever I record, I will upload but make the lecture live at 10 o'clock in the night. That is a time which I have observed where students watch their lectures, generally the online lectures. So I will be making them live at 10 o'clock. So accordingly you will have a few hours in advance, you will have information about the lecture being uploaded, so that you can support me, at least those of you all who wish to support me. In the last class, we finished the chapters related to assessment, the chunk of chapters related to assessment, that is IT authorities, search and seizure, assessment, appeals and revision. And in the order of textbook, we will go ahead. We have our next chapter. Let me remind you, this is revision lecture. So obviously, kindly do not expect detailed explanation of provisions, but very quickly, what is Income Tax Settlement Commission? If you want to surrender yourself, raise both hands and say, please, I am coming here and declaring all the concealments that I have done till now. Please waive what? Tax? No. No waiver of tax. No waiver of interest. If at all you will get waiver, you will get waiver of penalty, and most importantly, you will get immunity from prosecution. Waiver of penalty and immunity from prosecution. For that purpose, we have created an organization. That organization is called Income Tax Settlement Commission. There are a few sections, section numbers in these few chapters. Settlement Commission or Tonnage Tax Scheme or Penalties, Miscellaneous, not very important. AAR is in international tax, so that will be important. But very quickly, obviously you will have to make an application form 34B. Rupees 500 will be non-refundable. Once you file your application, then later you will not be allowed to withdraw your application. But obviously ITSC has the right to reject. Remember one very important aspect of the chapter, that once there is an order of settlement commission, either rejecting your application or the final order, orders of settlement commission are final and binding, and there is not going to be any appeal against that. Settlement commission will have a chairman, vice chairman from people who have outstanding ability, integrity and knowledge and experience in the field of accounting and taxation. So they have not prescribed any educational qualification, but obviously expert in the field of law and taxation and accounting will be preferred. Out here, an application can be made only when there is a pending proceeding. However, appeal, revision, rectification, reference is not considered as pending proceeding. So we are only going to cover regular assessment, reassessment, fresh assessment and search assessment. Only 4 types of cases you are allowed to make application, and only if it is pending. Till what date is an assessment considered as pending? Till the order or the last date of order, whichever is earlier. Your application will be maintained only on 3 conditions. First, pending assessment, already seen in the previous section. Second, you have to offer additional tax. Recently we made a meme and put it on our YouTube in the community in the post section. Your extra tax because of your concealment that you are declaring should be more than 10 lakh, and in such cases it should be exceeding rupees 50 lakh. This will cover only the tax amount. Interest will be separate. Only the tax, surcharge, HEC should together be more than 10 lakh, in such cases more than rupees 50 lakh, and this you have to pay before making your application. When you fulfill these conditions, only then your application will be accepted. And the other points are worth reading, that this extra tax can be per application, not per year. Sometimes you will make an application for multiple years, so your extra tax condition has to be fulfilled per application, not per annum. If you have earlier filed a return, then the extra amount should cross 10 lakh or 50 lakh. And if you have not filed return, then whatever you are showing right now is your extra tax only. So that should be exceeding 10 lakh or 50 lakh rupees. The procedure is like a story. You will apply, then they will give you a show cause notice. Then you have to reply to the show cause notice. So assessee has got 2 chances, application and show cause notice. Then they will give 1 chance to the commissioner. Commissioner has to prove if assessee has given any false information. If you are able to prove, then the application will be rejected. No appeal against that, but opportunity of being heard. Ponch. Principle of natural justice has to be followed. Then in the second chance, commissioner will present his case and request not to give you any waiver. Likewise, total 2 chances to the assessee, 2 chances to the department, and finally within 18 months from the end of the month of application, the settlement commission will give its order. as to how much waiver they are giving you, and if there is anything payable, you have to pay within 35 days. Otherwise, 1.25% per month or part of a month interest will get attracted. This is the procedure. As we are aware, the formal order, that is accepting or rejecting, and the final order, that is the terms of settlement, is final, non-appealable, binding. Only if fundamental rights are violated, then writ petition can be preferred. Powers of settlement commission: provisional attachment means they can take away your asset before passing the order. All powers of income tax authority, that is discovery and inspection, issuing summons, production of books of accounts and documents, custody of books and accounts and documents. Regulate on procedure means what time our office will open, what time it will stop, working hours, how many staff we will recruit, how many ACs will work in office. All that day-to-day procedure they will decide. The chairman of ITSC can transfer the case from one bench to the other. If there is any rectification of mistake, it has to be done within 6 months from the end of the month of application. But if it is increasing the liability, then you have to give an opportunity of being heard. Remember, the power to review, reconsider, reappreciate is not available. Change in opinion: review, reconsider, reappreciate. Review, reconsider, reappreciate. Change in opinion not allowed to anybody. Only High Court and Supreme Court will be allowed to do that. So Settlement Commission also will not be allowed. However, we have a Supreme Court judgment, Om Prakash Mittal, in which it was held: if Settlement Commission gave its order and then it is withdrawing its own order, withdrawing own order will not be considered as change in opinion or review. Declaring own order as void ab initio will be allowed. That is not considered as review. That interest which they are levying after 35 days, remember I told you in the procedure that if you don't pay within 35 days, then in that case you will have interest. That interest can be waived, but as we are aware, the essential interest of income tax 234 ABC cannot be waived. Supreme Court judgment, Anjum MH Ghaswala, Santram Mangatram Jewelers. Settlement Commission can grant immunity from prosecution and they can withdraw that immunity also. Obviously, they can withdraw, they can grant immunity and they can withdraw immunity, but if they are giving you immunity from prosecution, they have to give reasons in writing, and secondly, only if it was not already initiated. Once you make an appeal, if it gets rejected or in the final order there is penalty or prosecution, then you cannot make second appeal in life. That means who can make second appeal in life? If it is accepted, zero penalty and zero prosecution, then you can make second. But what sometimes people do, if I as an individual get rejected, then I make HUF and apply. So because of that, we are making the other assessee also disqualified. If individual is rejected, then a company where you are holding more than 50% and HUF where you are a karta, or a firm AOP where you are holding more than 50%, they will be disqualified, and vice versa. For company, that same individual; for firm, that same partner; for HUF, that same karta will be disqualified. So because of you, they will be disqualified. Because of them, you will be disqualified. You cannot even make your first application. Supposingly individual gets rejected, then the HUF where he is karta cannot make the first application also. That's our revision of chapter Income Tax Settlement Commission. Without wasting our time, we will go to authority for advance ruling. That's a chapter of international tax, and because it is international tax, it is relevant for paper number 7 new course in that 30 marks. And in fact, paper 6C international tax, this chapter is word to word copied over there, like your DTAA, like your transfer pricing. This is also copied. What is advance ruling? Non-residents are not aware of the laws of our country. They don't know when they come to India whether it will be slab rate or flat rate, whether it will be normal tax rate or minimum alternate tax rate, whether it is normal rate or special rate, whether it is rate as per act or rate as per DTAA. Non-residents don't know which provision of law will apply. So they can apply for an advance ruling to this authority. They will come and say, sir, we propose to do this transaction in India. What will be the provision applicable to us? Income Tax Act or DTAA? If it is act, then normal rate or special rate, normal rate or MAT rate, slab rate or flat rate. What provision of income tax will apply to us? Kindly give us clarification. If we are comfortable with the tax provision, then only we will do business in India. Otherwise, we will not do business in India. But this ruling will come with a condition that once you take the ruling, then you and the department both have to comply with the ruling. That one thing which everybody is aware about AAR is that order of AAR is final, binding and non-appealable. You will not be allowed to appeal against AAR. Very quickly we will see what are the applicants first and what can be the ruling. These are the applicants and these are the respective rulings: 1 to 1, 2 to 2, 2A to 2A, 3 to 3. Applicant and ruling. Non-resident can apply for self-owned tax liability. Then in the second case, resident having transaction with non-resident can apply for tax liability of the non-resident. In the third case, resident can apply for own tax only if the transaction is exceeding rupees 100 crore. And in the fourth case, public sector company can apply if there is any pending matter at AO, CIT, appeals or ITAT, that does not fit in the definition of advance ruling, but they have provided this facility for public sector company which are government owned companies. Constitution, there will be a chairman, where this time they have given qualification: judge of Supreme Court or Chief Justice of High Court, or minimum 7 years spent as High Court. Vice chairman, a person who has been a judge of High Court, and members will be from two categories. Revenue member can be from Indian Revenue Service or Indian Custom and Central Excise Service, and there will be a law member from Indian Legal Service. Obviously, if the chairman is absent, then the vice chairman will be doing the duties of the chairman, and that goes in any team. If the captain is absent, that vice captain will be doing the duties, and then AAR will have a lot of benches at different places. If there is any wrong appointment, supposingly a judge of session court has been appointed, but it will not invalid the proceeding will remain valid. If we require, we may appoint anybody, and thus 245P will end up cancelling 245. Oh, you will have to make, like you make an application to ITSC, you will have to make an application here also. Form 34C, D, DA and E respectively for the 4 applicants: non-resident for self 34C, resident for non-resident 34D, resident more than 100 crore 34DA, and public sector company 34E. For public sector company, we are keeping very little fees, 10,000 rupees, but for others, transaction up to 100 crore 2 lakh, 100 to 300 crore 5 lakh, and more than 300 10 lakh. This is application fees, not total income or tax liability. Here you can withdraw your application within 30 days. In ITSC, once you file, you cannot withdraw, but here you can withdraw. You will not get your fees back. They will be more than happy. In fact, after 30 days, legally you are not allowed. But if AAR wants, they can permit you. So within 30 days, you can withdraw application as per your wish. Beyond 30 days, if you want to withdraw your application, AAR can permit you to do so. Listen, they will be more than happy to permit you. Why? Because they just have to give away your application, not your fees. And here there is no criminal investigation, some evasion. This you have not even done the transaction. So where is the question of any evasion or anything? It's okay, you withdraw your application, we are happy, we will keep the fees. Not give you your money back, non-refundable. Okay. Section 245R procedure, this has to be a very small procedure, nothing much out here. First applicant will apply, then one chance will be given to the department also, and finally the AAR will give a ruling within 6 months from application. If the application has to be rejected, then opportunity of being heard has to be followed, but in certain cases without opportunity it will be rejected. The first 3 applicants, if the matter is pending anywhere, because it has to be advance ruling, so if there is pending matter, it will be rejected. In the 4th applicant, public sector company, it is allowed if it is pending at AOCIT or ITAT. So if it will be pending at High Court or Supreme Court, then it will be rejected. For public sector company, anything pending at High Court, Supreme Court, it will be rejected, and for the remaining, if it is pending at any level, it is going to be rejected. Lastly, in the case of public sector company, because somebody was already working on the matter was pending at AOCIT or ITAT, they will not be proceeding further, because now this case will be handled by authority for advance ruling. We are all aware that the ruling of AAR is binding on applicant, department, and the transaction. If you do the same transaction in future, if there is any fraud or misrepresentation of fact, then AAR can declare own order as void ab initio. AAR will also have all the powers of civil court, same given to IT authorities, same given to settlement commission, discovery and inspection, issuing summon, compelling production of books of accounts and documents, custody of books of accounts and documents, enforcing attendance, same powers. And AAR will also have the power to regulate own procedure. Regulate own procedure means start time of office, end time of office, everything AAR will be allowed to decide. That was your quick revision of your chapter, authority for advance ruling. Let's now go ahead. Tonnage Tax Scheme, special scheme for presumptive taxation for domestic shipping companies, because for foreign shipping companies, we already have 44B. This is presumptive taxation for Indian companies. First condition, you have to be a qualifying company. What do you mean by qualifying company? First, Indian company, POEM, that is place of effective management in India, should be having at least one qualifying ship and should be operating the ship. What do you mean by operating? It can be owned or rented. In renting also, it can be full rent or part rent. Slot charter or space charter is also fine. Owned or chartered is fine, and in chartering, even a slot charter is fine. And what is a qualifying ship? At least 15 net tonnage registered in India or approved by the Director General of Shipping, and the capacity certificate given by the Director General of Shipping should be enforced. When you satisfy these 3 conditions, you can calculate your normal income or you can calculate your presumptive income. In this chapter, if at all you have to learn anything, there are these 7 ships which are disqualified. You can read about them: factory ship, fishing vessel, offshore installation, pleasure craft, harbor or ferry, such ships are disqualified. And if there is one thing that you have to learn in this chapter, that is only calculation of tonnage income. This has never come in exam in the last 15 years. But if there is one thing that you should learn, that's calculation. The tonnage capacity of the ship will be given to you in the question. Ignore the kgs. So if they say 15,000 tons and 500 kgs, ignore the kgs. Just take the tons. That you have to take to the nearest multiple of 100. Supposingly it is 15,889 tons, then you will have to take 15,900. And if it is 15,820, then you have to take 15,800. Nearest multiple of 100. So first take the tons from the question, remove the kgs, take it to the nearest multiple of 100, and then apply the slabs. First 1,000, 70%, 70 per 100. Next 9,000, because it is 1,000 to 10,000 the next slab. Then it will be 53 by 100. Next to 15,000, from 10 to 25, it will be 42 per 100. And the balance, if any, will be 29 per 100. And this total is going to be, in fact, you can learn till 25,000, it is fixed, 11,770, like we learn our tax slabs also. This will be the tonnage income per day. And now this daily tonnage income will be multiplied by number of days, and that will become your total income. If there is any incidental profit can be maximum up to 0.25% of the turnover from main activity. If it is more than that, then you will have to take that incidental profit also in your income. And that's your revision of the chapter Tonnage Tax Scheme. Let's go ahead. Next chapter, we have a chapter called Penalties. Whenever you have committed violation, then you will be suffering penalty. This chapter is all about learning section, crime, penalty. Section, crime, penalty. There is more of learning and less of understanding. But if a question like this comes in objective, if they ask you calculation of 270A penalty, then you score good marks. You know it can come for 2 mark MCQ or 4 mark sum. And other than that also they can ask you any penalty by way of MCQ. There is very little to explain. You have to go through the table, but the little bit that has to be explained and that amendment that has come, let me explain that much part and we will quickly wind up our chapter Penalties. So first thing, 273B, whenever there is reasonable cause for default, if there are genuine circumstances, there will be no penalty. Obviously it is a question of fact, so you will have to prove that there was reasonable cause for default. Whenever there is reasonable cause for default, there will be no penalty. However, this facility won't be available. 278, that's a case of underreporting. 271 AAB is search cases. 271 AAC is undisclosed, unexplained cash credit, income, expenditure, investment. So again a case of concealment. And then we have a newly introduced section as an amendment. It will be taught to you anyways. 271 AAD incorporated with effect from AY 21-22. False entries or omitted entries, there is going to be 100% penalty. We'll talk about that in some time. These are all cases of concealment. Concealment, that means you have underdeclared your income. And because these are cases of concealment, here you will not get that facility of reasonable cause. There can never be any reasonable cause for concealment. So normally, if you don't maintain books of accounts, don't get an audit done, accept a cash loan, repay a cash loan, any of the crimes, you will be getting the facility of reasonable cause. If the circumstances were beyond your control, then you can excuse yourself from payment of penalty by proving the reasonable cause. But in these cases, you will not get the facility. Now let's talk about the first section 270A, which I will explain in detail, and then I will directly take you to the amendments. And at the end of the chapter, I have made a table, section, crime, penalty. That table will help you to quickly revise and quickly understand the various penalties. 270A, penalty for underreporting is going to be 50% of underreported tax, and penalty for misreporting is going to be 200% of underreported tax. So on the same amount, it will be half or double. So your first two steps will be same, whether underreporting or misreporting. Calculation of underreported income, calculation of underreported tax. First two steps are going to be same. Then if it is underreporting, you do half. If it is misreporting, then you do double. So what are the cases of underreporting? First, if your income is more than basic exemption, you don't file ROI, then it is underreporting. How we will compute your underreported income? Assessed income minus basic exemption. Be very careful. If the income as per best judgment assessment is 15 lakh, then the underreported income, our mind is saying 15, but in reality it is 1250 only. As per definition. Yes, underreported tax will be calculated on full 15 lakh. But the definition of underreported income is going to be assessed income minus the basic exemption limit. Assessed income minus basic exemption limit. That's your underreported income. How to calculate underreported tax? Underreported income plus basic exemption, calculate tax. That means, can I say calculate tax on assessed income? What is underreported income? Assessed income minus basic exemption. And how to calculate underreported tax? You have to calculate tax on underreported income plus basic exemption. This plus basic exemption is nothing but this only. So in effect, your tax calculation won't be wrong. Penalty won't be wrong. But in MCQ, and they have asked a question, it is there in our MCQ book also. We'll be talking about it in the MCQ series, if at all we are doing the MCQ season 2, because currently there are big doubts over there after I narrated the story to you in the previous episode. So if at all I will do it, then I will be covering that some obviously in my MCQ lectures. It is already there in my book. Okay. So if you don't file ROI, assessed income minus basic exemption will be underreported income. Calculate tax on assessed income, that will be your underreported tax. Half will be underreporting penalty, double will be misreporting penalty. Underreporting and misreporting will always happen together. If you go by the definition, underreporting is not filing return or showing less income, or in subsequent assessment, their income in reassessment, the income has increased, or you have claimed false carry forward of loss. And misreporting definition includes things like false entry, misrepresentation or suppression of facts, income not shown, false expense shown, investment not shown, transfer pricing transaction not reported. When we learn the definition of underreporting and misreporting, this is revision. When we learn, we realize that both will always happen together. And there is still controversy. This provision came in AY 1718 and there is still controversy about when alone underreporting or alone misreporting will happen. They will always happen as of now together. And to address this problem, what institute did is, in all the sums, initial solutions, they assume no misreporting, assume no misreporting, assume no misreporting. And these days what they are doing, every time they are asking a question, in the question they are mentioning, calculate penalty if it is a case of underreporting, calculate penalty if it is a case of misreporting. So the moment they mention underreporting, you have to do half. If they mention misreporting, you have to do double, because underreporting is 50% half, misreporting is 200% double. So you have to do the first two steps: underreported income, underreported tax, and the question will tell you whether underreporting or misreporting, half or double. First case, income more than basic exemption, return not filed. Assessed income minus basic exemption is income, but tax will be calculated on assessed income only, half or double, what question mentioned. Then when your assessment has taken place, at that time, if your assessed income is more than, not your return, if your assessed income is more than the income as per 143.1, if assessed income is more than 143.1, then that difference will be underreported income. Calculate tax on both amounts, that difference will be underreported tax, half or double. Then whenever your subsequent reassessment happens, that is reassessment, every time a fresh assessment, every time a new assessment happens, then previous income and current income, the difference between them, the new decided income, will be again your underreported income. And again you have to calculate tax on both. You cannot calculate on the difference directly, you have to calculate tax on both. That difference will be your underreported tax, and again half or double. And lastly, if you are showing a loss and later on if that loss is reducing or converting into profit, here you have to take the difference, because there is no other option. The difference will be underreported income. Calculate tax on the difference, assuming that that is the total income, and that will become your underreported tax, again half or double. Here we are making a controversy, or we are making a compromise, because we don't have any other option. Apart from that, they have given, this is cases of misreporting, these are cases of misreporting, and these are cases where your penalty will not be attracted if you have given proper explanation and your AO is convinced, or if he is making any intangible addition, any estimated addition in your income by using estimate, then there will be no penalty. Then if it is a surge case, we already have 271 AAB, so this penalty will not get attracted. And lastly, if transfer pricing transactions are reported, then again not attracted. That was your underreporting and misreporting penalty. In 270 AA, you can request for waiver. If that application is accepted, that means no penalty, but condition is that assessment is final. Then tax, as per what we have decided, we will not levy penalty. And if this is rejected, you can't appeal against the rejection, but you can appeal against the tax liability. So if your tax will get reduced, automatically penalty will get reduced, but the rejection is not going to be appealable. After you learn the calculation under 270A, in any of the other section, there is no calculation. Section crime penalty. Section crime penalty. That's a constant thing. So in the theoretical part, what I will do is I will only talk about the amendments. 2 new sections have been introduced, and then I will take you to the table and revise the entire chapter from the table with effect from AY 21-22 if it is found during any proceeding that in the books of accounts by the assessee there is any false entry. A lot of people do that. Lot of people, they false purchase, false sales, any kind of false entry or any entry relevant has been omitted. False entry or omitted entry. So simple, sales not shown or excess purchase is shown. Lot of people do that. See, supposingly I have a gold jewelry showroom. You come to my shop, you buy in cash. I give you my gold. So my stock has reduced, but that's cash sales. So I am not showing because you have not paid me in check. So I cannot show your KYC anywhere. You have purchased in cash. Now I will have to book that sales somewhere because my stock has reduced. My stock was recorded in my accounts. Because I sold in cash, the stock disappeared. So people make fake sales bill. So they approach in the market. Anybody wants bill? I will give a bill in your name. You will get input tax credit also. I will give a bill in your name. You have to give me check. I will return that cash. So the real transaction is done with someone else and the bill is taken in the name of someone else. This is called the bill business. And this bill business specially to claim fake input tax credit under GST for that evasion in a big level that is done. Now with computerized environment it is easy to catch. So anybody doing false entry or omitted entry, the penalty will be equal to such amount. 100% of the false entry or omitted entry will be that amount, and any person who is helping that, the intermediary also, that person will also be liable for 100% penalty. And what is the definition of false entry? Using false or falsified documents such as a false invoice or a false piece of documentary evidence. That means, can I say your fake e-way bill, your fake sales bill, fake purchase bill, that's a false invoice. Invoice in respect of receipt or supply of goods or service. Listen, receipt or supply, goods or service, everything covered by the person to any other person without actual supply. Did I tell you that we are supplying to someone else but making the bill in the name of someone else only to show the transaction? So without physical delivery we are actually showing. Many a times it happens, supposingly I want to show income for loan purposes and you want to show expense because your tax is coming, you're at a very high level. So what I do is I will give you a bill of professional services. You give me check, I'll give you cash. I have not worked for you, but you want to book expense, I want to book income, and there are intermediaries. Especially, very sad to say, but a lot of chartered accountants are involved in this. They have one party who wants to book expense, other party who wants to book income. They make them meet each other. They give the bill, give the check, take the cash, and then in between everybody is earning. Everybody is having benefit. So without doing transaction, if you make a bill, it will be a false entry. And sometimes we do transaction with people who don't exist. Hashtag swag. We do transactions with people who don't exist. All that will be considered as false and omitted entry, and 100% penalty will get attracted. And the second amendment that has taken place, remaining we will do directly from the table, with effect from 1st June 2020. All the research association, college, university which get the donation in section 35. So the donors give donation and they take 35, say the deduction under section 35. The college, association, university or the company, they get, or the charitable trust gets donation in 80G. So listen, we get tax benefits when we give money for scientific research to college, association, university or company, we get benefit under section 35. And if we give donation to charitable trust, we get benefit under 80G. Now we are making a requirement that this trust, association, institution, college, university, company will have to file an online statement. Details of donors. From where have they received their donation? There will be a specific form which will be notified called annual financial statement. In that they will give the KYC of the donors, and the moment they submit this return, automatically in the donor's return that deduction will get reflected. Supposingly I give donation to a charitable trust. That charitable trust will take my PAN card, Aadhaar card. It will file a statement, and in the statement that charitable trust will write my name, that it has received donation from me. And the moment that statement is furnished in my form 26AS, news for you is our form 26AS is going to change altogether. Not just your TDS or advanced tax details, all other these donations will be automatically available. Things are going to be easy for us as chartered accountants, because whatever financial transaction assessee has done, everything will be shown in autofill. It will come in our income tax return. So these organizations will file that statement and automatically it will come exactly like TDS return. In TDS, the payer files the return and the payee gets credit. Here, same thing will happen, the trust, the company, the research association, institution, college, university, they will file return, and in the donor's income tax return automatically that deduction will come, and not filing this will attract penalty of minimum 10,000, maximum 1 lakh. And for this they have introduced a new fees also, 234G. So 234E was late filing of TDS return, 200 rupees per day maximum to the extent of TDS. F was income tax return, we saw in assessment procedure. G will be this same as TDS, 200 rupees per day and maximum to the extent of amount involved. This concept has become exactly same as our TDS return. In fact, penalty also for TDS return, it is minimum 10,000, maximum 1 lakh. So this entire concept has become exactly and drastically similar to your concept of TDS return, both in terms of penalty and also in terms of fees. So this was your second amendment of the chapter, and apart from that, the remaining stuff can be studied directly from your chart. For your misreporting, underreporting penalty, I already taught you. Not maintaining books of accounts, 25,000 rupees. Flat if you don't keep data, document, information, 2% of the value of transaction. And then in 286, if you don't inform, then there is another 5 lakh rupees penalty. If you have section 271 AAB, that is in search cases, then we have 10%, 20%, or these days we have 30% and 60% directly of your undisclosed income. 271 AAC was with respect to your unexplained cash credit money, unexplained money investment expenditure. 10% of that tax, that tax which is in 115BB, 60% basic, 25 surcharge and 4% HEC, 78% tax and 10% penalty. AAD we saw right now as an amendment, failure to get a tax audit done, 0.5% of turnover or 1,50,000, whichever is lower. Not getting form 3 CEB by CA, 1 lakh rupees. Then TDS not deducted, 100% of the amount. TCS not collected, 100% of the amount. Cash loan accepted or repaid, again 100% of the amount. 271 DA, that 2 lakh or more you cannot receive in cash, which is discussed properly in miscellaneous provision. If you receive 2 lakh or more in cash, 100% of the amount. If your last year's turnover is exceeding a certain amount, then this year you have to provide facility to your customers to pay through other prescribed modes like UPI, QR code, RuPay debit card. If you don't provide that facility, then 5,000 rupees per day penalty will get attracted on you. If you fail to furnish your statement of financial transaction, then 500 rupees per day penalty. After you get notice, it will still be 500, but if the notice time limit expires, it will become 1,000 rupees per day. If you give false information, 50,000 rupees penalty will get attracted. Non-resident investment fund not furnishing activities in India, 5 lakh rupees penalty will get attracted. Data document information non-maintenance, 2%, non-furnishing 2% will get attracted. If an Indian company has got foreign ownership, it does not report the transaction. Change in ownership, then 2% penalty, and any other transaction, then 5 lakh rupees penalty. Then if you don't furnish your country by country report on time, then per day penalty is attracted. Initially 5,000, then 15,000, and after order it will be 50,000 rupees per day. If you furnish wrong information in your CBC report, then 5 lakh penalty. Flat TDS, TCS return late filing, minimum 10,000, maximum 1 lakh, but this comes after 1 year of delay. But from first day you will have 234E fees, 200 rupees per day maximum to the extent of TDS amount. Failure to furnish information about remittances, that's a printing mistake, this should be 1 lakh rupees. Form 15 CACB, 1 lakh rupees penalty will get attracted. Wrong information given by a CA, merchant banker or registered valuer, 10,000 rupees per default will be 271J. This was the newly introduced section about statement filing by charitable trust, companies, research association, institution. For certain non-compliance, not replying to summons or notices, etc., 10,000 rupees, and for some cases they have given you 100 rupees per day of default. Door-to-door survey. Door-to-door survey, if you don't comply with that form 45D, which we did in the last class, 1,000 rupees penalty will get attracted, and all the defaults related to PAN and 10,000 rupees penalty. PAN not applied or not quoted, do 2 permanent account numbers, false quoting of PAN, 10,000 rupees penalty. PAN or Aadhaar will get covered out here. As far as offences and prosecution is concerned, remember, income tax is a fiscal law. The objective of this law is to generate money for the government, not to arrest you. Objective is not to arrest you. So till the time you are paying money, we don't want to arrest you. In extreme cases, we will arrest you. Only for objective questions you should learn or read through at least the jail term which is prescribed out here. Once you read it from here, that much is going to be more than enough. That was your chapter called penalty. Let's go ahead. Next chapter that we have is a chapter called miscellaneous provisions. I am not going to go into the detail of this chapter. I will just quickly revise this chapter for you. We cannot consume in the revision lecture time for a chapter like this. These are general rules and regulation. If during pending proceeding you transfer your asset, that transfer is going to be void, the AO for protection of interest of revenue can do provisional attachment, and after provisional attachment they will pass the order. If you don't pay, they already have your asset, but personal assets cannot be non-transferable assets cannot be taken up in provisional attachment. You can give a bank guarantee if you want. How to serve a notice? Post, hand delivery, or these days electronic mode. Notice has to be authenticated. Authenticated matlab it has to be means it has to be signed by hand. When HUF is disrupted, then notice has to be sent to all members, and in case of firm it can be sent to any adult member. Indian company having foreign ownership will have to give information, otherwise penalty will get attracted. Then statement by producer of cinematographic films about all the payments more than rupees 50,000 has to be furnished, otherwise 100 rupees per day penalty. Statement of financial transactions. Certain assessees are required to report certain transactions, and if they don't report these transactions, then again 500 rupees per day, and after notice expires 1000 rupees per day penalty will get attracted. Annual financial statement. Did I tell you Form 26 AS has undergone complete change? Completely your Form 26 AS has changed, and now your Form 26 AS will contain details about TDS, TCS, specified financial transaction, payment of taxes, refund and demand, pending and completed proceeding, and DTAA information also. Everything will be contained in your Form 26 AS. We are drastically modifying your Form 26 AS and making it such that it will contain all the details. The only section that I am going to tell you a little properly is this section 286, which is about country by country report, because it is based on international tax. BEPS action plan number 13 given by OECD, uniform transfer pricing documentation. If you operate in multiple countries, to comply with transfer pricing document requirement of every country, there will be difficulty, plus companies will get different information, the various governments. So we will have columnar, country wise, all the financial detail. If your total group turnover of the last financial year, means all the group companies total turnover aggregate of the last year is exceeding 750 million euro, then in the current year you can follow this. In India, how have we adopted this concept? By incorporating section 286. There will be a master file that will contain information about the entire group. Local file will contain information about the individual entity, and financial information will be submitted columnar manner, CBC report, that is country by country report. Every entity in India, so the main organization will be called parent entity, and all the subsidiary organizations will be called constituent entity. If you are a constituent entity in India, there are chances that you are the only entity, then you have to do all the reporting and furnishing CBC report. But if there is more than one constituent entity in India, then what you will have to do is appoint one of the companies, one of the group companies as your alternate reporting entity. ARE means that company that will give information to the income tax department. So supposingly there are two companies, Mumbai and Delhi. Mumbai company will be giving all the information. That means Mumbai company will become alternate reporting entity. Delhi company does not have to do. But every constituent entity, Mumbai and Delhi both, have to go and inform whether they are the ARE or they are not the ARE. So Mumbai will go and say, I am the alternate reporting entity. I will furnish CBC report. Kindly do not harass my Delhi company. And Delhi company also has to go and say, sir, I am not the alternate reporting entity. Mumbai company is my alternate reporting entity. Kindly take all the financial data from Mumbai company. Please do not request for anything from me. You have to at least go and communicate whether you are the ARE or you are not the ARE. And only this failure attracts 5 lakh penalty. Only to go and communicate, sir, I am the ARE, sir, I am not the ARE. Only this failure will attract a penalty of rupees 5 lakh. Thereafter, all the duties have to be done by the alternate reporting entity, which is in our example Mumbai. Within a period of 12 months from the end of the reporting accounting year, you have to prepare the consolidated financial statement and submit. But obviously, the alternate reporting entity will furnish. So Mumbai will furnish, Delhi does not have to. And that also if the parent entity is non-resident. If the parent entity is in India, I told you in the last lecture also, if you have your parent, then you don't have to bother about anything. Problem arises when you don't have your father. Then there is a lot of problem in life. So if your parent entity is non-resident, then ARE will be doing all this. It should contain country-wise information about revenue, profit before tax, income tax paid, details of capital. Stated capital means share capital. These are international tax terms. No? Accumulated earnings means reserves or surplus. Number of employees, tangible asset other than cash and cash equivalent, and each other's residential status you have to furnish. All of that you have to furnish all the information, and if you don't furnish, then there is going to be that penalty under 271 GB. Initially 5,000 rupees per day, after 1 month 15,000 rupees per day, and if order is passed, then 50,000 rupees per day. The other data is very simple. Assesses information if in general public interest. registered valuer can go and explain valuation up to ITAD, because it's a question of fact. We can have an authorized representative. If we don't understand the law, we can send somebody to argue on our behalf, and here they have brought one amendment. So till now it was employee, relative, CA holding COP, lawyer, officer of bank account, any person who has passed a CBDT recognized exam or CBDT conducted exam. CBDT can give recognition to other exams or themselves conduct exam, but now we will have one more person, and this same CA holding COP, this accountant also does certification work like trust audit, political party audit, tax audit, book profit audit, your adjusted total income AMT audit, your 15 CA, 15 CB. Then this CA, if he is related to you, he will not be allowed to do that certification work, because CA Act also has that prohibition. Next, we have income and tax should be rounded off to the nearest multiple of 100. Whenever you make a payment, you will be getting a receipt. If we have done recovery on behalf of other persons, supposingly we have recovered money from trust and we took the trustee's money. So we wanted tax from the trust, but we took money from the trustee. So then in that case, the trustee can be indemnified. Cognizance of any offense means if you have to give a jail term, only presidency magistrate or magistrate of first class. If there is any clerical error, then your return, your notice will not become invalid. If you want to challenge the validity of the notice, then only if you have not replied. If you have cooperated, then you cannot challenge the validity of the notice, but before assessment order you can challenge. There will be presumptions, same as search, belong to the assessee, contents are true, signature, handwriting attestation done by the same person of whom it appears. 292cc. We can have one authorization for multiple search, and that will be considered as authorization for all the individual assessees thereunder. Next, you cannot file case against any officer for any act done in good faith, like especially in search cases, if they have done some breakage in your house, you cannot claim compensation. Then if they can grant you permission, they can condone. See, we have already certain places where CBDT has been given power to condone, but wherever it is not specifically mentioned, at that place they will be allowed to condone your delay. If they have given you approvals, they will be allowed to withdraw your approvals. If the new budget is not enacted, then the existing budget will continue, and all the rules about how to enact Income Tax Act, the rules will be made by CBDT. Act is being made by Parliament, but the rules are going to be made by CBDT. CBDT will be making rules about day-to-day enactment of income tax law. Lastly, we have 269 AST. From one person in a day or in respect of single transaction or transactions relating to an event from one person, if you accept 2 lakh rupees or more, other than the 3 allowable modes, that is account pay check, account pay draft or electronic mode, then 100% penalty is going to get attracted, with exceptions being received by government bank or loan, because that 20,000 limit is already applicable, or any other notified transaction. And if your last year's turnover exceeds 50 crore rupees, then in the current year you will have to provide a facility to your customers, whether to avail or no, that is their choice, but you have to provide facility of RuPay debit card, Bheem UPI and UPI QR code. And if you don't provide, then you will have a penalty of 5,000 rupees per day. But CBDT released a circular and said that B2B transactions shall be excluded from this, because generally if manufacturer is selling to wholesaler, that transaction happens through NEFT. Manufacturer cannot have a QR code or a code which you have to scan in the factory, that wholesaler will be paying through NEFT as per business policy. So this is applicable only to retail, that is consumer sale. Only B2B transactions are going to be immune from this. That was our chapter called Miscellaneous Provisions. Let's go ahead. Next chapter. It's become a little big now, but fair enough. TDS, that is tax deducted at source, and lot of amendments actually, but I will give you a trick of how to understand and learn those amendments better than anybody else, even if they have more views. Okay, what is TDS? Whenever one person is making payment to another person, for the payee it is income, for the payer it is expense. The payer, being the source of income, has to deduct. After deducting, deposit that tax to the government. So that way it is not a profit for the payer, and likewise it is not a loss for the payee, because whatever tax has been deducted, that much you have to pay less at the end of the year, because you get credit against your tax liability. If I am paying 1 lakh professional fees to a chartered accountant and I deduct 10,000 TDS in that, my expense will still be 1 lakh, because that other 10,000 I have to pay to the government. And the income of the CA is 1 lakh, because the 10,000 which he got less right now, he is going to get it back. Sir, how? Because he has to pay that much tax less, he will get credit. This will facilitate reporting of transactions, those transactions which were otherwise going underreported or unreported, now because of TDS, because of credit, the payee will be showing those transactions. So all responsibilities of the TDS chapter are on the payer. Deduct, give it to the government. There is a frequency, we'll learn that. Then file your TDS return and issue the TDS certificate so that the payee can get credit of the same, and failure will attract interest, penalty and everything. But now let's understand a few things in TDS chapter. The basic funda, obviously you know that the most important sections of TDS are 194 ACHIJ, Archie, hot favorite of ICAI, we all know. In fact, we have a table over here also from which we will be revising our TDS chapter. So what we will do is, from the PDF we will be doing the amendments, and then from the table we will quickly do our full chapter revision. First, this point, this is not entirely an amendment, just a clarification. That, do I need to tell you that way as a professional, as a CA, I get payment after deduction of TDS. But in case that person, supposingly one of the classes with whom I am working, they have not deducted TDS, does that make me immune from taxation? No, I have to make direct payment. So supposingly I get 1 lakh, TDS is deducted, but still offer 1 lakh to tax, and whatever is the TDS, take credit. No problem. Supposingly that class has forgotten to deduct TDS, they gave me full 1 lakh. No problem. I have to offer that 1 lakh to tax and pay tax. I have to make something called direct payment. So TDS is only a deduction of tax. It is not a levy of tax. It is not that if TDS is not applicable, that means it is exempt income. Or if the payer forgets to deduct TDS, then okay, I will enjoy now. I don't have to do anything. If TDS is not deducted, I have to pay direct tax. And for this amendment that came in self-assessment tax section, in demand notice section, I said I will explain here. If you are an employee of an eligible startup, ATIAC, then you are getting sweat equity shares, because startups don't have funds to give you salary, so they give you partnership. Sweat equity, that tax you don't have to pay right now, not even in self-assessment tax, not even in demand notice, and not even in direct payment. You don't have to pay tax on that right now. That tax has to be paid within a period of 14 days. From when? From the expiry of 48 months from the end of relevant assessment year. So say you are allotted sweat equity in previous year 2021, then your assessment year will be 21-22. From there you have to count 48 months. So you can say 2 years, that's 31st March 24, and from there 14 days, that's 14th April 24. You have to do tax payment at that time, self-assessment tax or demand notice or direct payment of tax. In fact, salary TDS will also come at that time. So your income will be taxable in the current year, but whatever tax is arising, we will take after 2 years. From where you will count 2 years? 2 years from assessment year, 48 months from assessment year. And what is the due date? 14 days from the expiry of 48 months. So previous year, assessment year, 48 months from assessment year, and then within 14 days you have to pay that tax. Or second, supposingly you sell, is it possible that during this period of previous year, assessment year, 48 months, you have sold? Then that event. Or if you leave your job, whichever is earlier. So if you sell the shares, that's the first event. Or if you leave the job, that's the first event. Or if you don't sell and you don't leave the job, then 48 months from the assessment year. Out of the three, whichever is earliest in these three. In these three, whichever is earliest, from there you have to pay the tax within a period of 14 days. Tax rate will be of current year. Listen, the income has accrued in the current year. You got your sweat equity in the current year. Tax rate will be of the current year. Only payment will be postponed, like we do, in capital gain for compulsory acquisition and conversion of capital asset into stock in trade. Income is arising in the current year, but you pay tax in a future year. Same concept. Income has arisen in 2021. Tax will be calculated at the rate of 2021, but paid later. Later means 14 days, within 14 days from the earliest of these three events. Sale of those shares, seizing your employment, or expiry of 48 months from the assessment year, whichever is earlier. From that, within a period of 14 days, you will have to pay this tax. These are cases where TDS will come only at the time of payment. So normally TDS comes at the time of credit or payment, whichever is earlier. Rate and monetary limit is given in every section. Normally surcharge and HEC won't be added, but for salary and non-residents, we have to always add surcharge and HEC. The payee will have to furnish PAN. If the payee does not furnish PAN, then minimum TDS will be 20%. And there is a newly introduced section, but let me take you to that point. If the payee does not furnish PAN, then minimum TDS is going to be 20%. But for RPF section, it was maximum marginal rate. And then from 1st October, we have a new section, e-commerce section. So all your e-commerce transactions will now suffer TDS. For that, it is going to be 5%. So normally if you don't furnish PAN 20%, but for RPF maximum marginal rate and for e-commerce section it is going to be 5% instead of 20%. That's your duty. Only one duty of the payee, furnish your PAN, otherwise your TDS rate will become higher. Normally whichever is earlier, but in these 9 cases it will be at the time of payment. And now we have this very important amendment that has taken place. The whole world is suffering due to COVID-19, and finally COVID-19 finds a place in income tax also. Now they are saying that in a lot of sections of TDS we are going to reduce the rate as a temporary relief measure to improve cash flows. Suddenly one day finance minister on 13th of May came and said, I am reducing TDS rate by 25%. What is the reduction? 25. That means 10 will become 7.5, 2 will become 1.5, 1 will become 0.75. These are the existing TDS rates. Already you were required to learn that. Now these rates will reduce by 25. That means the rate will become 75% of the existing rate. But you have to note the following things. First thing, this will be applicable from 14th May because the announcement was made on 13th May. This is very difficult. Your previous year is 2021. All the students giving exam in May 21, November 21, your previous year is 2021. This is 14th May. 13th May she announced, and from 14th May it became applicable. For the period from 1st April to 13th May, the old rate will apply. And for the remaining period of the year, the new rate will apply. That means you don't have to only learn the change. You have to learn the old rate and the new rate. Old and new, both are going to be applicable. From 1st April till 13th May, the old rate, and from 14th May to 31st March, the new rate. And I already told you what is the difference, 25%. So that's good, because if you learn only one of them, automatically you know that the other rate, see 10 is 7.5, 2 is 1.5, 25% rate reduction. But important thing is, this will be applicable from 14th May. 14th May. And second difficulty, this is still easy. Okay, I know that up to this date old rate, after this date new rate. But a bigger problem here, that this has not come in all sections. In some section the reduction is applicable, in some section it is not applicable. In every section I have written COVID reduction, that means 10 will become 7.5 applicable from 14th May. I told you that. Or not applicable, that means full year it will remain 10%. In every section I have written. In the table that I have made summary of TDS, there also I have written. But sir, how to learn? CA Siddharth Surana is going to today give you an idea. Any section which is related to salary, that is salary recognized provident fund. Any section which is related to non-resident, or let me write on the notepad, anything related to salary. So that salary RPF 192, 192A. Anything related to non-resident, whether it was non-resident foreign national sportsmen sports association, whether it's the main section of non-resident, or your 194 LB, LBA, LBB, LC, LD, wherever you have non-resident. And any section which is incorporated for prohibition purposes. Prohibition means your casual winnings, that is lottery, your casual winnings in the form of horse races, and there is one section. We want to prohibit cash withdrawal from bank account. These are sections in the nature of prohibition. In these sections, salary related, NR related, and prohibition related. In these sections, the rate reduction, COVID-19 rate reduction is not applicable. And in all other sections, for example, interest, commission, professional fees, rent, royalty, any other section, e-commerce, some newly introduced section like e-commerce, share of profit from company, that is dividend income, and share of profit from mutual fund. These were exempt till last year due to removal of DDT. They have become taxable and there will be TDS. In all other sections, 10 will become 7.5, 2 will become 1.5. Existing rate will reduce by 25%. So all you are required to remember is 3 occasions COVID reduction won't apply. Any section which has got relation with salary, like salary RPF, any section which is related to non-resident, and any section which is prohibition. In prohibition there are only 2. In salary there are only, in prohibition there are only 3. Salary there are only 2. So these 5, 2 of salary, 192, 192A, 3 of prohibition, casual winnings, lottery, horse races, and withdrawal of cash from bank account. and anything related to non-resident. These provisions reduction won't apply. Everywhere else, for example, ACHI, JCHIJ reduction will apply, but from 14th May. So that is how you can learn. And lastly, in that section 206AA, where the payee does not furnish PAN and minimum TDS becomes 20%. For RPF, it will become MMR, and that new section, e-commerce, it will become 5%. In that also, this relaxation is not applicable. That COVID relaxation will not apply if you don't furnish your PAN. So I think this amendment, which is that way complicated because it is from the middle of the year. So you have to remember till 13th May and from 14th May. I have changed all questions of the textbook. I had to enter the date of transaction to know old rate or new rate. Second, some sections it is applicable, some sections it is not applicable. What is only easy thing to remember? 25% rate reduction due to COVID. What is difficult? It is from the middle of the year and it is for selected sections. I have made both easy. You have to remember 14th May and you have to remember reduction not applicable in 3 cases. What 3 cases reduction not applicable? First, salary related. Second, prohibition related. And third, non-resident related. Okay. That was your introduction of TDS chapter, and in this I cover the concept of equalization levy, also the existing provision of equalization levy, 6 conditions: non-resident, no PE in India, specified service, that includes online advertisement, digital space for online advertisement, and any other notified, more than rupees 1 lakh, provided to a resident for the purpose of business. For the purpose of business. This is important condition. In MCQs we have question on this. Then 6% equalization levy will get attracted and thus payer has to deduct. That's under Finance Act 2016. The existing provision of e-commerce equalization levy covered only online advertisement services. But with the flow of e-commerce, now what we are going to do is all e-commerce transactions will attract equalization levy. All e-commerce. And now we have got, this was our existing 6% equalization levy. We will be having a new 2% equalization levy. That is also an amendment. So these are revision cum amendment lectures. 2% equalization levy whenever an e-commerce supply or services takes place. Whenever an e-commerce supply. First of all, what is e-commerce supply? Online sale of goods owned by the e-commerce operator. Who is the e-commerce operator? Who is e-commerce operator? A non-resident not having a permanent establishment in India. Same as the 6% condition. Non-resident, no permanent establishment in India, who owns, operates or manages a digital or electronic facility or platform for online sale of goods or online provision of services. Owns, operates or manages a website, an app, a portal for digital supply of goods or services. That is a non-resident e-commerce operator. So listen, an e-commerce operator is doing business. Non-resident, no PE. Non-resident, no PE. If it is resident, then that new section 194O will apply. For resident e-commerce, we have 194O. For non-resident, we have this equalization levy. Non-resident, no PE. E-commerce operator means he has website. What is he doing? He is selling goods owned by himself. You can sell your own goods from your website. You can provide your own services, or you can act as a portal and sell goods or services belonging to others. Sometimes there are aggregators, a company like Amazon. That website is selling, not selling any own goods. Amazon does not have own goods. It is selling goods belonging to others. So that e-commerce operator is selling own goods or own services or acting as an aggregator. But this will not apply where 6% is attracted, obviously. So if it is advertisement service, then 6% will apply. But all other goods and services, provided you are earning a total of 2 crore or more. So threshold is on the higher side, but obviously companies like Amazon, etc. will automatically be having 2 crore rupees or more. Then you will have equalization levy. And who is the payer? The payer will be a resident. Obviously resident, or a person buying goods from IP address in India. Supposingly a non-resident comes to a picnic in India, and from India you are accessing Amazon website. So you are also non-resident, Amazon is also non-resident. But the IP address, that means you are booking, you are accessing the internet from India. Then that will also attract equalization levy. Or a non-resident in respect of sale of advertisement, which targets a customer who is resident in India. Means one non-resident is selling advertisement to another, and the target customer is a resident in India, or he is accessing the advertisement from IP address in India. You are targeting Indian customers. That means again India is involved. So payer will be resident or a non-resident if accessing IP address from India, or sale of advertisement where the target customer is in India, or the customer will access that advertisement from IP address in India. We have a lot of these foreign companies who provide Instagram followers, Twitter followers for some of our professors, YouTube followers, YouTube views. So you are getting advertisement services. The customer, the target customer. Do you know who is the target customer for professors who are getting paid subscribers? So the target customer is accessing that advertisement from India. If that total is 2 crore or more, then now 2% equalization levy will get attracted here also. And once this levy is attracted, whether 6% or 2%, we all know, once equalization levy is attracted, then in India there is not going to be any tax on that payment. Once equalization levy is attracted, then no tax on that. Are we clear on that? Okay. Now, apart from that, all the TDS sections, see, you will have to learn payer, pay, rate, monetary limit. Introduction, they had some amendments. I discussed that. COVID relaxation, I already told you that amendment. In every section there is an amendment, but I told you how to learn whether that relaxation is applicable or no. Now what I am going to do with you is, I am going to take you through the chapter, through the amendments, and last we will revise from the table. That employee of e-commerce, self-assessment tax or demand notice or direct payment, or if the employer is deducting TDS, all that will be applicable, not currently rates of the current year, but payment after 14 days from 3 events, whichever is earlier, 48 months from assessment year, seizure of employment, or sale of your security. Okay, EPF, all these relevant. Some of them are relevant, some of them are irrelevant. In our full course and crash course, both we have given the markings to the student of 2-star, 1-star, read and useless provisions. That marking is given. In fact, TDS, a chapter like TDS, business profession, capital gain, transfer pricing, some of these chapters, the entire chapter of full course is provided to crash course students also. Crash course, we can reduce content to save time, but there are some chapters in which we cannot have any reduction. Chapters like TDS, business profession, capital gain, transfer pricing, they have been given full directly from full course. We have copied for crash course students because detailed learning is only advisable. This dividend section, which was no TDS till last year, now there will be TDS because dividend is taxable. But if you are paying to resident individual in a non-cash mode and up to rupees 5,000, then there will be no TDS. In your 194A, that is interest other than securities, and in fact all the 5 sections, ACHIJ, there is one amendment. In ACHIJ, one amendment. When we were defining the payer till last year, we were saying all persons other than individual HUF. Individual HUF, if their last year's turnover is exceeding 44 AB limits. But now what has happened is 44 AB has undergone change. Certain cases the turnover has changed from 1 crore to 5 crore. And so there are complications. So what they have done is, here they have directly specified the amount. If your last year's turnover in business is exceeding 1 crore or in profession is exceeding 50 lakh, business more than 1 crore, profession more than 50 lakh, then in that case current year TDS is going to get, you will have to deduct TDS of other people, and the same amendment has happened in ACHIJ, all 5 sections. So we will not see 44 AB, now we will directly see 1 crore or 50 lakh turnover of the last year. And secondly, here in 194A, sometimes cooperative societies were not liable to deduct TDS. One cooperative society to another cooperative society, one cooperative society to its own member, there was no TDS. But if your cooperative society's last year turnover has exceeded 50 crore rupees, if the turnover of the last year had exceeded 50 crore rupees, then that cooperative society will be liable in the current year also. So these are amendments of 194A. Apart from that, these are basic sections where every section you have to learn the payer, pay, rate, monetary limit. Okay, and there is not much. I'll only talk to you about these sections that have got amendment. I already told you about ACHIJ, about the definition of payer that has undergone amendment. In contractor, obviously the payer's definition has undergone amendment. The relaxation part is there. And when you are supplying goods, and you are giving specification, that becomes work, because your job worker is only doing the labor work. But now if the goods are taken from you or from your relative, that will also amount to work. So if I give goods and I give specification and I pay you only for service, that was work. But if I give goods from my relative, that will also amount to work and will get covered under contractor. From raw material taken from the customer or relative of the customer. Then again in rent, 2 amendments. One, the definition of payer, and second, COVID relaxation. So these amendments I have discussed, I will not talk about them, whatever I have spoken already. In your section of professional fees, again, the definition of payer has changed. Your COVID relaxation has become applicable. But here the rate has also changed. Earlier we had only 2 rates, 10% and for call center 2%. Now we have got some more cases of 2%. Call center 2%. All fees for technical services will go in 2%. Obviously, after COVID 1.5. But till last year, professional fees, fees for technical services, royalty, non-compete fees, director sitting fees, everything was 10%, except call center. Now all fees for technical services will go in 2%, and royalty, which is with respect to cinematographic films, will also go in 2%. All other payments, including other royalty like copyright, trademark and all, will go in 10%. So call center 2%, fees for technical 2%, royalty for films 2%. Everything else, professional fees, royalty other than films, director sitting fees, non-compete fees, that will go in 10%. Obviously, after COVID, it will become 7.5. That you have to see. From 14th May, it will become 7.5. Distribution of profit by mutual fund, it will now become covered under TDS because the income is taxable more than 5,000. 10% TDS will get subtracted. Relaxation is also going to be available. 194M, personal payment for contractor commission or professional fees more than 50 lakh. Only that relaxation, no other amendment. LA and IA, again, no further change. Then these are few sections applicable to non-residents. You can directly study your special rates of tax chapter. Whatever amendments we have studied in special rates, only those amendments are applicable. Nothing new. We have this new section, e-commerce services through residents. So for non-resident, we have equalization levy. And now with respect to resident, if there is any e-commerce operator that is paying an e-commerce participant. So supposingly I sell my books or my video lectures through Amazon or any of, in fact, there are quite a few websites selling my lectures. So that website or that portal owner is the e-commerce operator and I am the e-commerce participant. Whatever payment I get from the e-commerce operator or e-commerce participant, 1%. This section has come from 1st October. That means right from day one, it is going to be 0.75 because from 14th May itself, we have 25% rate reduction. And if you are making payment to individual HUF, who furnishes PAN or Aadhaar and the total does not exceed 5 lakh in a year, the total does not exceed 5 lakh in a year. In that case, there will be no requirement to deduct TDS. Other than that, all types of e-commerce transactions will attract TDS. In fact, they have not prescribed any other monetary threshold also. For non-residents, all payments which are not already covered, they will be liable for TDS. Out here, in fact, no COVID relaxation. Grossing up principle, if the payment is net of tax, then you have to do back calculation. These people, if you are paying them, if they are the payee, no TDS. Pay. If they are paying, they will deduct TDS. And then after completing the deduction duties, we have some general rules. Pay by the 7th of the next month. But TDS of April, TDS of March has to be paid by 30th April. Payment has to be made monthly. Returns have to be quarterly. 31st after the quarter. Late filing of return, 200 rupees per day, but maximum to the extent of the TDS amount. And if it is more than rupees, or if the delay is more than 1 year, then minimum 10,000, maximum 1 lakh penalty also will get attracted. Then we have to issue TDS certificate. For that also, if there is delay, there is going to be penalty of 100 rupees per day. For certain sections, there is going to be return cum payment. For sections like 194 IA, for section like 194 IB, it is going to be return cum payment within 30 days from the end of the month of liability. If there is failure to deduct, or if you deduct but you don't deposit, then there will be 100% penalty. Then there is going to be disallowance in PGBP, non-deduction or deduction but not paid up to due date of return filing. Then there is going to be disallowance. For resident pays 30%, non-resident pays 100%, and if paid in future year, so whatever is disallowed in the current year will be allowed in that year. And there is going to be interest. For non-deduction 1%, for non-payment 1.5% on the TDS amount. Non-deduction and non-payment, there is going to be interest. Okay, so that was your general rules and regulations about TDS. And as I told you, at the end of TDS, from this chart you will come to know the payer, the payee, the nature of payment, rate of TDS, and the section number. If you revise, whenever you revise, you make sure that you revise this entire chart. And in the chart itself, I have mentioned whether relaxation applicable or not applicable. Wherever applicable, I have written. If you observe, again, salary related, prohibition related, and non-resident related, COVID relaxation will not be applicable. After we finish TDS, we go to TCS. In that also we have some amendments. First part, whenever we are selling to resellers, selling to trader, selected products, this is going to be the rate of TCS. Existing COVID relaxation has come here also. I'll talk about that COVID relaxation after I complete entire TCS part. Don't worry, seller of goods will collect it from the buyer. Something like input tax credit in GST, buyer can claim that credit and seller has to deposit. Here all the duties will be on the seller. Collect, deposit, file your TCS return and issue the certificate to the buyer. Part 1 is only applicable if it is sold to a trader. So in retail sale, it is not going to be applicable. Selected products at the specified percentages which you will have to learn. Seller and buyer has been defined. Seller is same as your hot favorite Achij pair. If last year turnover exceeded 1 crore or 50 lakh for individual HUF, otherwise all other will be covered. And buyer means all of them, but we will not collect TCS from central government, state government, embassy, commission, consulate, trade representation club or retail sale. Okay. Then we have got part 2 of TCS, sale of licenses, parking lot, toll plaza, mine or quarry, 2% TCS will get attracted. Part 3, sale of motor car, more than rupees 10 lakh, any amount at the time of receipt. Normally TCS comes debit or receipt, whichever is earlier. But for motor car, it will come at the time of receipt. If there is sale of motor car more than 10 lakh rupees, then 1% TCS will apply. Again, COVID relaxation I will talk in some time. From the people whom you were not collecting in part 1, you won't collect. But there is one difference between part 1 and here. In part 1, in retail sale, there will be no TCS. Only manufacturer to wholesaler, wholesaler to retailer, there will be TCS. As against this year, only in retail sale. That means if Maruti is selling one car to one of the dealer, no TCS. But when I go and purchase that car in the dealer, with the dealer, only sale to consumer will attract TCS. Only sale to consumer will attract TCS. In part 1, only sale to dealers. And here, sale to dealers, no TCS. No TCS. Okay. Here also individual HUF, if last year their turnover had exceeded 1 crore in business or 50 lakh in profession, the limit that they have given 10 lakh is per transaction. If I buy 10 cars of 8 lakhs each, no TCS. Whichever car is worth more than 10 lakh, that will attract TCS. I have recently purchased a car more than rupees 10 lakh. So I can say that they check the ex-showroom price. If you ever purchase vehicle, you know that there is one ex-showroom price. Then they have some RTO charges, some insurance charges, some registration charges. And then there is a total amount that you have to pay. On that ex-showroom amount, if that is more than 10 lakh, then the dealers are taking 1% TCS. In my case, it was post-COVID, so 0.75. I will talk about that relaxation very soon. So, at the time of receipt, if the car is worth more than 10 lakh, then 1% is going to be applicable. And then we have two new cases of TCS, part 4 and part 5. In part 4, whenever you are making payment, that means if there is an authorized dealer who is remitting outside India money, foreign currency, or if there is a overseas tour package, seller of overseas tour package or authorized dealer from whom you are buying foreign currency for making a foreign remittance, then they will collect TCS by irrespective of mode and debit or receipt, whichever is earlier. So, two people, tour package and second dealer of foreign currency, both of them will collect TCS. In case of tour package, it is direct 5%. No other discussion. Whenever you go now for a foreign tour, 5% extra you have to pay. So, if your tour package was 1 lakh rupees, you have to pay 1,05,000. Direct 5%. Don't worry, that's not your extra cost. Don't forget, whatever TCS we pay will be available as credit at the end of the year. So, whatever TCS has gone, it will come back for you in the form of credit after the year end. So, 1 lakh will be your cost, but 5,000 will be recovered as refund later. And in case of a dealer, authorized dealer of foreign currency, up to first 7 lakh, no TCS. So, here you don't have any threshold. Every rupee there will be TCS. But for other cases, other than tour program, first 7 lakh, no TCS. Beyond 7 lakh, there will be TCS only on the excess. That means, in case of tour, 1 lakh tour, 5% TCS. 10 lakh tour, 5%. Any amount, 1 rupee tour. Stupid example. But 1 rupee foreign tour, 5% TCS. In case of other foreign remittances, first 7 lakh, no TCS. If it is 8 lakh, still first 7 lakh, no TCS. On the excess, we will apply TCS. For loan, for higher education, 0.5% and 5% in all other cases. So, first 7 lakh, no TCS. Beyond 7 lakh, example 8 lakh, then only on 1 lakh. In case of foreign loan, then 0.5%. And in all other cases, 5% TCS will get attracted. If there is TDS, then there will be no TCS. Obviously, there are certain cases where we are making payment to a non-resident. We have deducted TDS. Then there will be no TCS. Sometimes what happens? We buy foreign currency from this dealer. And then with that money, we buy the tour. Okay. So, supposingly this tour dealer is already collecting TCS from me, then this forex dealer will not collect because we want TCS only at one level. And then we come to the last part, a very, very controversial part, because now all businesses will be suffering this with effect from 1st October. If your last year's turnover exceeded 10 crore rupees in business, turnover of last year more than 10 crore, and in the current year you are selling more than 50 lakh. My last year's turnover more than 10 crore, and current year I am selling more than rupees 50 lakh, then on the amount exceeding 50 lakh, I will collect 0.1% TCS irrespective of nature of business. Supposingly I am a gold dealer, I was not covered in TCS anywhere. Now, if my gold is such a valuable asset, if you make 2-3 transactions in the year, then also you cross 10 crore rupees. Last year turnover was more than 10 crore. And current year, if I sell 1 kg gold to anyone, that 1 kg also will become 55 lakhs. So on the excess over 50 lakh, and then obviously once I cross 50 lakh from one party, any other transaction in the current year, which we have already crossed 50 lakh rupees. If last year turnover is more than 10 crore, current year any party, it is obviously party wise, you are selling more than 50 lakh, then the excess over 50 lakh, there will be 0.1% TCS. 0.1%. So supposingly last year my turnover was more than 10 crore. Current year, one party I am selling 60 lakh, one party I am selling 40 lakh. 40 lakh no TCS. On the 60 lakh party, only on the 10 lakh amount, there will be 0.1%. And this will apply at the time of receipt. This is receipt basis, not when we are making the bill, receipt. So 40 lakh no TCS. Another 10 lakh no TCS. Now I receive any rupee, there will be TCS. The TCS will start from 1st October. But the monetary limit will be checked from 1st April. Start from 1st October, but the limit will be checked from 1st April. And again, if TDS is deducted, this won't apply. Here also, it will be the duty of the buyer to furnish PAN. If you don't furnish PAN, then your TCS will be double rate or 5%, whichever is higher. So if your existing rate is 2%, double is 4 or 5, whichever is higher, that's 5. If your existing rate is 5%, like foreign tour, then double will become 10. 10 or 5, whichever is higher. If you don't furnish PAN, then double rate or 5%, whichever is higher. Double rate or 5%, whichever is higher. But this last case, where it is 0.1%, then 5 will be very high. We will make it 1%. That's 10 times. So normally, if you don't furnish PAN, TCS will become double or 5%, whichever is higher. Double or 5%, whichever is higher. But in that last 206C1H, that latest addition, it is going to be 1% only. Not double, it is already 10 times. Okay, and then we have got COVID relaxation, same. First, it is from 14th May. So good, same as TDS. Second, that reduction is 25. So whichever section it is 1%, like motor car. My TCS was only 0.75 because it was post-COVID. 1 will become 0.75, 5 will become 3.75, whatever is the existing rate. But it will not apply. To what? First, in part 1, we have alcoholic liquor. 1%. In that, it will not apply. So, it will apply to tendu leaves, it will apply to timber, forest products, scrap, minerals, but not for alcoholic liquor. And under part 4, foreign remittance, in that it will not apply. And like you don't furnish PAN in TDS also, you don't get relaxation. Here also, you will not get relaxation. So, 3 cases where relaxation won't apply. 1, don't furnish PAN. If you don't furnish PAN, then double or 5%, whichever is higher. But 206C1H, it will become 1%. Relaxation not available. In category 4, foreign remittances, no relaxation. And third, in alcoholic liquor, in that part 1 only alcoholic liquor. 3 places you will not get relaxation. Everywhere else like TDS, even TCS rate will reduce by 25% from 14th May. Don't forget that. Clear? So that was our chapter TDS and TCS. This is real achievement then that in our episode number 5, we have finished TDS and TCS. So in our next episode, we will be having all the small chapters, volume 2 will get over up to transfer pricing, and maybe because salary house property I am going to be doing very fast without going into much detail. So I think I will be able to finish that also. Let's see. Target is a little over 1 hour in every episode. These episodes, because of the request that I made in the last episode 4, I am going to be uploading them. See, if I immediately upload, then you may not be able to watch them immediately. So these episodes are going to be uploaded by way of a premiere, and you will be knowing at least few hours in advance that the episode is premiering in the evening, so that you can adjust your timetable for that. And I request you to please support me. We will call the end of episode 5, 100% English version. It happened, long class. Okay. So thank you very much. See you in the next episode. All the best, please.